In the days following Saturday's election call, I had the opportunity to speak with three of the country's most prominent economists. Dr. Lawrence Yun, Chief Economist of the National Association of Realtors, the world's largest real estate trade association. We talked about the economic outlook for 2021. Dr. Marianne Wanamaker, Professor of Economics at the University of Tennessee, Knoxville, former Chief Domestic Economist on the President's Council of Economic Advisors, and member currently of the Federal Workforce Policy Advisory Board, chaired by Ivanka Trump and Wilbur Ross. We talked about the labor market. And with my friend and colleague, Dr. Svenja Gudell, Chief Economist of the Zillow Group, we talked about mortgage rates and housing. These are their takes on the economy, the labor market, and housing. I am delighted to be joined by my colleague and friend, Dr. Lawrence Yun, the Chief Economist and Senior Vice President of the National Association of Realtors. I think, Lawrence, by any measure, the largest real estate industry trade association in the world. Is that right?
Well, we are approaching 1.5 million members. So yes, it is the largest trade association, certainly for real estate.
Fantastic. And I think like everyone else in the industry, very grateful for your work in helping to articulate conditions in the real estate market, both residential and commercial, and to raise some of the challenges that we may face in the industry with your colleagues inside the Beltway. We did just have an election outcome announced over the weekend. While we know who the president-elect is, the next couple of weeks may be challenging in managing the transition. But overall, with a Democratic administration coming in, with there still being some uncertainty around who will control the Senate, what are your general expectations for the performance of the economy over the next couple of years, and how the incoming administration will really prioritize some of the potential investments to get the economy going again?
Oh, well, from NAR's perspective, we have one of the largest political action committee where we engage in races, but we never get involved in presidential race. So we will work with whoever occupies the White House. And related to Joe Biden's campaign, at least in their some of their proposal as related to real estate, a few interesting points. One is home buyer tax credit. It will have some income threshold, and therefore you'll principally benefit the first-time buyers, $15,000, and is refundable pretty much right away. So it's essentially a down payment assistance at the time of closing. And certainly, I think Joe Biden is looking at that home ownership is good for the middle class. Widening the excess is good. We certainly don't want to have a repeat of the subprime lending where we overstretch people's budget, implosion of the loans and foreclosure crisis, none of that. So we want to assure successful home ownership. And one way, aside from the credit condition, is to assist on the down payment. So we are pleased on that. However, that is not the full story, because what is important is not only stimulating the demand, but currently we are in housing shortage situation, just not enough inventory. So if we don't increase supply and just stimulate the demand, it's just simply going to ramp up home prices. And I'm not sure how far that $15,000 will stretch when the prices will be rising, possibly proportionally. So increasing supply is critical. And under Biden's proposal, at least in the first reading, it has a 1031 exchange, which is critical for commercial real estate, possibly selling of the raw land to home builders. And it may limit some of those sales transforming raw land into developable lot if 1031 exchange is removed. So certainly we will be communicating with the Biden camp related to how important 1031 exchange is. But those are two major issues that we see as related to the incoming president.
So one of the things that you highlighted just a few days ago on a webinar for the National Association of Realtors that I had the privilege of joining you for was that when we look at some measures of the performance of the economy, certainly in a visual gives the appearance of a V-shaped recovery. But as you, I think, correctly pointed out, we're starting from a very low place. And so we're still not quite back to where we were in terms of pre-pandemic levels of economic activity. Uh, what are your expectations for how the broader economy will perform in 21 and 22?
First, we know that vaccine will be discovered. The Pfizer news, that's very good news. But even if that was not to turn out, there's like 20 different drug companies pursuing it. So we know one will succeed, widely available, hopefully by spring of next year. That will help on the consumer activity. There was a massive stimulus package, the CARES Act, which provided some income support for small business owners for some time, and also the enhanced unemployment benefit. And if one looks at the overall income, the personal income in the aggregate, it actually rose during the pandemic, even though there were fewer people working. But the savings rate tremendously rose because people could not go to restaurant, they could not attend sports events. So hopefully with the vaccine discovery and availability that some of the consumer spending will go into the economy and help generate the economic growth. The second component is the really residential real estate, just exceptionally hot, certainly surprised me. I thought that when the pandemic began, the fundamentals were such that we had a housing shortage, so maybe home prices would not decline. But I never expected home prices to be rising in high single digits, in some market, double-digit rate of appreciation. If there is a V-shaped recovery, I would say it's the housing sector with home sales in the recent months actually doing better than what it was 1 year ago. So I think the housing market momentum looks good. And this combination should propel the economy, GDP, to possibly grow about 4 or 5% in 2021. But that does not mean we are back to normal because we had that big drop in the spring. The percentage gain in the third quarter was good, but we are still short about 10 million jobs to get us back to normal, but moving in the right direction. The vaccine will certainly help the commercial real estate as people go to the restaurant. Maybe people return to office spaces. So the commercial real estate, which has been hampered, I think could begin to see some revival with the vaccine.
So when you describe a growth rate of 4 or 5%, that's atypically strong for the U.S. economy. Are there chances, are there risks of significant increases in inflationary pressures that might lead the Federal Reserve to tighten up on monetary policy? Does that then lead to a rise in mortgage financing costs for prospective homebuyers?
The Federal Reserve has clearly indicated that they want to pursue a maximum liquidity policy or possibly all the way to 2022, which means that Fed funds rate essentially at zero, quantitative easing in some degree pursuing. But the actual interest rates for the consumers could rise if inflation picks up. We just have to remember the 1970s or early 1980s when inflation is high. Well, the lenders have to be compensated for the loss in purchasing power, the money they receive back. So they have to charge higher rate independent of the Federal Reserve. But my guess is that given the higher than normal unemployment rate condition, that inflation will really not be a factor for next couple of years, maybe down the line. Now, under Biden's administration, certainly I think some of the stimulus measure they want to pursue will be larger than say what it would have been under Trump administration, which means inflation would be a few decimal points higher, possibly other things equal. And the appointment of the Federal Reserve governors, I think Biden administration will be more accepting of some new governors who are more dovish, meaning that they will tolerate inflation rate of say 2.5% or even 3%. So given some of the new appointment that is likely to take place at the Federal Reserve, all is pointing towards higher inflation than under Trump administration. But nonetheless, I don't see any inflationary problem or pressure over the next couple of years. It will be more down the line.
Right. So you mentioned the labor market, as being one of the reasons why the Federal Reserve will intends to and has articulated that it will maintain an accommodative policy bias. What is your characterization today of where we are in the labor market? What are your expectations for the next year? Obviously, saw a historic loss of employment. Some of that, a significant share of that, having come back. Who are the winners and losers in the labor market recovery thus far?
So far, the massive job losses have occurred in the leisure and hospitality sector. Now, for non-economists, leisure sounds like just playing around, but from industry jargon, what it means is that people working at the restaurant, people working at the hotel industry, these were the areas that impacted significantly in terms of job losses. One can even say frontline workers. Now they were principally lower wage industry and they lost jobs. So it's a very difficult situation related to job security. Fortunately, unemployment insurance was enhanced for many people who lost job, at least for several months. The paycheck was from the government, unemployment check was a little larger than the wages they were receiving. But there's a great deal of uncertainty going forward. Now there is a reduced amount in terms of unemployment insurance. And second, what would be the next stimulus measure? Office-related jobs, some industry may be a light job cuts, but in other areas, actual job gains. So interesting part is people who would typically work in an office, their jobs have been fairly immune to any downturn. Yet they're not going to actual office; they're working from home. But the office workers, higher paying job, they have been fairly immune. And I think this is what the economists are referring to the K-shaped recovery. That good portion are seeing upward direction in terms of jobs and wage gain, while the frontline workers are seeing a loss of job as well as just trying to struggle and trying to come back.
Sure. You mentioned the enhanced unemployment benefits, some of the other benefits included in the CARES Act. There had been hope, I think, in August and early September that we might see, some of those measures extended, and we did not. In the aftermath of the election, what's sort of commonly described as a lame duck session of Congress, is it possible to conjecture whether or not we will see another round of stimulus, another round of benefits for some folks that may be going into their eighth or ninth month of unemployment just as the winter sets in?
Well, when the new president comes in, there is always that honeymoon period where people are willing to give some aspect of the plan for the new president. So, Biden camp has laid out the plan. But what happens during the lame duck? My guess is that there are people struggling at the moment. They're depleting their savings. So some light stimulus package, I believe, will be passed during the lame duck session to get the money out to the people. One sticky point as related to the Senate, Mitch McConnell, and the House, Nancy Pelosi, was the funding for the state and local government. And I think that may be not available until 2021, but during the lame duck session, I think the goal is to get the money out to people and businesses, small businesses.
Sure. How are small businesses doing in your view?
It's a little better than anticipated in light of the fact that we went through the lockdown. I mean, there are some small businesses still hanging on by this is their final couple of months unless new stimulus measure comes in or vaccine is discovered. So you're trying to buy some time to get over to the other side. But in the meantime, like the restaurant business, some are using something called ghost kitchen concept. A lot of delivery to get their business survival. The others, like even the airline industry, interestingly, is slowly coming back. I think airline has made a good effort into terms of trying to educate people to say, they refresh the air every 2 minutes. So trying to catch the virus inside a plane is minimal. And then you look at the hotel industry, even though the air travel is, about half the normal, the hotel industry is almost becoming like 60% occupancy, which will be considered, I think, decent, like normal recession, not a big downward recession. So people are willing to go out and travel, but these are more of an automobile type of travel rather than air flight travels.
Sure. So as you mentioned, going into the downturn, we had seen some erosion in affordability in the housing market, in part because there's been so little in the way of new construction activity particularly for the homes that might be appropriate for that first-time buyer, or for the person for whom homeownership is aspirational. Um, does that get easier then? You described the $15,000 credit. If that's net new, all else being equal, that will certainly help some folks get into home ownership. Um, What does the housing market look like a year from now?
The momentum on home building has been steadily ticking up for the better. I think we need to get more smaller mom and pop builders back into the game. So far, it's been enlarging of the market share by the large builders because one looks at the overall home construction, and for the past 10 years, we have been below average. Looking at the long-term average, 1.5 million housing start, we have been under that for the past 10 years, and the cumulative impact of that is we simply don't have enough homes for sale. And hence, as we build more homes, and it doesn't have to be the first time buyer homes, it could be larger, expensive home, but those homes are for trade-up buyers, and in the process, they release their current existing homes onto the market as they trade up into the new home. So it starts that chain reaction, cascading effect. So it's all about the builders building more. And maybe the builders will get more excited and confident that there will be plenty of buyers with the $15,000 tax credit. But there are other angles, like material costs are high, lumber prices have almost tripled from the beginning of the year. So maybe reduction in the tariffs, say Canadian lumber, will help the builders. And also for the long term, trying to provide a steady flow of people coming into the construction industry. One hampering point was not enough people with skill set. So maybe enlarging some vocational training. Maybe this is something bipartisan agreement under the new president. I don't think it's a partisan issue, just trying to provide more money funding for vocational training so people can go into construction. And interestingly, construction job pays on average about $1,100 per week, while people working at the retail or the restaurant is only half that. So it will be a good opportunity for people who lost jobs in those leisure and hospitality, possibly get a vocational training and go into construction.
So, in discussions with your and my colleagues at the National Association of Home Builders, these are two of the issues that come up quite frequently in our conversations. One is the cost of building materials and softwood lumber in particular, but also the shortfall in the availability of skilled labor with relatively higher wages. Our economics 101 analysis will tell us that more people should be going into the construction trades, this increase in labor costs or compensation to skilled construction workers, is not something that's just happened during the pandemic. Why have we not seen more people go into the construction trades?
Yeah, I think part is trying to convince the parents. I think every parents would like to see their kid go to universities, colleges, 4-year degree. But we know the reality. The reality is that some people who enter college, they never complete. So I think one has to always look at that. Maybe some people are not cut out for college, and maybe rather than taking on those large college student debt, go into the vocational training, possibly at very minimal cost or subsidized, and then start earning middle income salaries right away.
Sure. So one closing question for you, and I do appreciate your time. I know what a busy week this one is in particular for you. Um, there's been a lot of discussion around this mass exodus from urban cores to the suburbs. In your view, how real and sustained is that? Do we face a scenario over the next couple of years where certainly there's this upside in terms of housing demand, um, but on the other side of this story, do we face a couple of years where cities are under significant stress because of an exodus of population?
If the pandemic had occurred a decade ago, I think American economy would have been wrecked because we would not be able to work from home. We didn't have the high-speed internet available. Fortunately, due to technological advances, we can work from home. Now, it will be very interesting to see how the CEOs of major companies decide to say, do you call people into office 5 days a week as before? Or there will be some resistance among employees to say, no, I can work from home. I am more productive working from home. So I think there will be some negotiation as to how much of the commute that people will be required even after the vaccine discovery, some hybrid model. I know that some of the technology companies are already permitting a very flexible work schedule, work from home, in some cases forever. And if that's the case, some of the high cost regions of the country, San Francisco, New York City, they will be more vulnerable as people will seek out larger size home at more affordable prices elsewhere. But we also know from managerial theory that we need to get people together for collaborative, and that's where the innovation, the difference between productivity is doing the repetitive work again and again, and working from home, it can really work. But innovation is where you have to share the ideas with other colleagues, improve upon, and that only comes from interaction. And Zoom technology is somewhat cumbersome. One truly do not get that innovative thoughts occurring, the new products, new service. So there will always be need to go back to office, but I think some type of hybrid. So my best guess is that the suburbs over the next couple of years, and or even just this could be the start of a long-term trend. I think the suburbs will do well. Downtown is more about the younger people, the liveliness of the street, able to go to a restaurant, go to the theater, go see a ball game, coffee shop. There will always be that amenities that draw the young people. So I think there will be slight swing in the major cities. It may take a few years, 2-3 years to get back to normal, but I think the suburbs should hold very strong.
Sure. One last question for you then. Overall, when we're thinking about the economy and the labor market and the direction of things, optimistic for the next couple of years?
I am optimistic related to the economic recovery. I think maybe even by end of 2021, we may be very close to say 5.5% unemployment rate. That would be the optimistic scenario. But even if we get 6% unemployment rate, economic 101 say that's a pretty good economy. So I think we are getting there, and the vaccine will be the key. But it looks like the vaccine is on the way.
I'm delighted to be joined by Marianne Wanamaker. Dr. Wanamaker is professor of economics at the University of Tennessee, Knoxville, a research associate at the National Bureau of Economic Research, and a research fellow at the Institute of Labor Economics. She is the former chief domestic economist at the White House Council of Economic Advisors, where she was also the senior labor economist. Dr. Wanamaker is currently a member of the Federal Workforce Policy Advisory Board, chaired by Ivanka Trump and Wilbur Ross. Marianne, thank you so much for joining me.
Thanks for having me, Sam.
So you are one of the nation's leading experts on the labor markets, and perhaps even more importantly, the interaction of labor markets and the policy choices that we're making at the federal level. To kick us off, give us some context. We obviously experienced a very deep set of job losses, a historic set of job losses in the early months of the pandemic. What has happened since then?
Yeah, you're right, Sam. It was just really an astounding amount of job loss in March and April. And I think we can say we've half recovered. And our prospects for full recovery are, I would say, lengthening in time. So initially, I think we were hopeful that maybe this really would be a V-shaped recovery. Maybe by the end of the year, things would be back to normal. And that's clearly not going to be true. And so now I think most people are thinking it'll be at least 2022 before the labor market returns to its previous job numbers.
When we look at the distribution of jobs that we've been able to get back, what are we able to say about geographic differences, differences across different types of occupations? Who has been able to get back to work? Certainly, for many of us, our experience of the pandemic has been quite different from what we see in the data. We've been able to work remotely, remain productive, continue to contribute. That's not the reality for everyone. Who has been able to get to work in these numbers?
Yeah, I mean, for the most part, you can think about the jobs recovery as being sort of mechanical. Industries that are allowed to function in geographies where they are allowed to function have recovered for the most part. There's some exceptions to that. So although it is legal for me to go to a hotel, I'm unlikely to actually do so. So the entertainment hospitality industry continues to struggle, despite the fact that in most locations they are allowed to be open. They just don't have the demand. And so at the beginning of the pandemic, of course, there were lots of people who mechanically had lost their jobs, lots of places that were required to be closed. My neighbor is a dentist, right? All of his people went on unemployment. But then when they were allowed to reopen in May, it was automatic. He hired every single one of them back. And so now what you're seeing is there are still some industries that are not allowed to be open in some places. And the remainder is just a lack of consumer demand. And those industries we expect will recover once we have wide coverage of the vaccine, people return to their previous consumption patterns.
So with some degree of uncertainty remaining around the timing of the vaccine, certainly seems like we've gotten some very good news over the last couple of days about the efficacy of one of the vaccines that's in late stage trials. There are questions that remain with regard to how quickly we'll be able to deploy that vaccine to a very large population, at least domestically in the United States. Given that uncertainty, is it possible to posit a time frame for a more robust recovery in the labor market, or does it really all hinge on that?
It does hinge on that, and there will be a lag. So typically in a recovery, in a recession recovery, what you see is that even after GDP returns to its previous levels, it takes a full year for employment to return to its previous levels. So you can sort of think about employers in the US sort of run hot for a year. They overwork their employees. They're producing the same amount they were producing before with fewer workers. And it takes time for the labor market to catch up as applications come in and people are hired, and also as employers become more certain that they really need these workers. And so at this point, I think we anticipate the same thing in this recovery, that now most of the people who are going to return to work are going to go to a new employer, not their old employer. And so those questions about hiring and onboarding and vetting and that sort of process takes over, and it will take a while. So again, even if you think that GDP recovers in mid 2021, which I think is a reasonable expectation, it's still probably 2022 before you see full jobs recovery.
One of the things that a lot of people had been looking for earlier in the summer, in August, early September, was the possibility of another round of supports, as we saw in the CARES Act. That isn't something that we saw the parties come to agreement on. It's unclear whether or not there will be another round of supports between now and late January. How important, how material is that for your thinking about labor market recovery?
I mean, I think it's pretty material. And the reason is that, the jobs recovery has been as strong as it has been, and the GDP recovery has been as strong as it has been, largely because consumer spending, at least in the beginning of the pandemic, did not fall. So we did a really good job, and we deserve, or we should give Congress a lot of credit for replacing income very well all the way through July, such that consumer spending didn't really change. What's happened since then has been weaker consumer spending numbers because people are feeling the full effects of job loss now in their monthly incomes. And so if we fail to provide that backstop going forward, and we don't give families additional support through UI, then we should expect to pay the price of that in terms of consumer spending, and that in turn has job consequences. So it's sort of a vicious cycle here, that we don't provide the support, we don't get the consumer spending we need to come back to full recovery, we have additional job losses, and we can't get a robust recovery without that additional support.
So, we have a very large number of our colleagues and peers in industry and in policy that are participating in this conference, but also a large number of students from universities all across the United States. Perhaps, one of the optimistic notes you've sounded is that if you're still a year away or so from graduation, you may be entering a much more robust labor market than where we find ourselves today.
Yeah, that's right. And my advice is go to grad school. Hang on somewhere that's not the labor market. I mean, what we know about graduating into a recession is that it puts you at a disadvantage for at least 10 years, right? So you are much better off if you can figure out a way not to be a new labor market entrant during a down year.
So 10 years sounds like a long time. What does that mean, or what are the implications? What can we infer then about those millennials that may have entered the labor force for the first time during the great financial crisis, and perhaps in the last couple of years have really only now started to see sort of their career develop the kind of momentum that you and I and others may have experienced right from the outset?
Yeah, I mean, I graduated in the '01 recession, and we thought that was the end of the world, And so then, of course, watching my students in the '08, '09 recession, I realized that we'd had it easy. Yes, I mean, the bigger the recession, the bigger the cost. And that 10-year number is an average actually coming out of the '01 recession. So it's more likely that graduates in 0809 will experience more than 10 years of income reductions relative to their peers, and graduates who came out this year almost certainly will see the same thing. And so again, hanging on, staying in school if you can is always the right solution.
Yeah. But to your point about, when people are re-engaging in the labor force, they're not necessarily going back to the same job that they had prior. In some cases, those new jobs will require a different set of skills. As educators, I think we're both always thinking about how is it that the educational infrastructure of the United States can support people in, as they seek to retrain, develop new skills, re-engage, become relevant again, or remain relevant in a labor force where, the demand profile changes over the course of the cycle. Um, when you've had the opportunity to work in the White House, the Council of Economic Advisors, now with working on federal workforce labor policy, what should we be thinking about, whether it's in academia or even more broadly, about the kinds of policies and about the kinds of steps that we can take to ensure that, every American has a chance to get back to work?
Yeah, I mean, I'll tell you how my thinking on this has shifted, and this is just my thinking. It doesn't reflect any policy of this administration or any future administration. But the way I've been thinking about this is that we've spent a lot of time and effort trying to figure out how to set up America's education infrastructure. Okay, meaning public institutions and private institutions, but with public support, right? So federal grants that cover education and retraining. And in the pandemic, of course, what happened was that the nature of skills required shifted so quickly, right? We went from kind of full employment and we needed skills and sort of across the board in all sorts of industries, to a real concentration of need in particular industries, right? So IT experienced a huge growth in labor demand in April and May, as did sort of warehousing and transportation and distribution. And so these very concentrated pockets of need. And I think it's really quite impossible for America's traditional education infrastructure to supply that. And so what I've been thinking about is, should we think about a world in which the federal government subsidizes training within private employers? So sort of cut, and I recognize that you and I are in the education industry, and I just cut us out of this equation. But I do think that at least it should be an option on the table. Is it worth it from a public policy perspective to directly pay an employer or a group of employers together to train their own workers, recognizing that there are public benefits to that, right? Obviously, the employer gains, the employee gains, but the American public also gains by kind of accelerating the movement off of unemployment and into employment. And so that's one of the policy implications I've been thinking about, is whether we need to have a more nimble job training infrastructure.
And what is your expectation at this point, or what does your research and empirical work thus far tell you and tell us about whether or not that would be an efficacious policy?
Well, we certainly know that private businesses respond to incentives, right? So I don't think there's any question about that. We also know that one of the reasons you might be concerned about such a policy, right, is that, well, what if employers train somebody and then they get up and leave tomorrow, right? What if employees are really fickle? And then how are we going to incentivize employers to do this if they don't think they can hold them to their employees? And so what research says is actually the opposite of that employees are not terribly fickle. They're no more fickle today than they were in previous generations. Millennials are not bad employees, despite what you might hear. And there's nothing to indicate that the nature of American employment is shifting in a way such that employers should be concerned about investing in their own workers. That doesn't seem to be the case. So I'm optimistic that there's a version of this policy that would be very effective.
The one closing question for you then, when we're thinking about where people will work, this, certainly on the real estate side, when my colleagues that own large office buildings, whether or not work from home, working remotely, continues to play, a dominant or simply a significant role in how we think about place of work going forward, particularly for, for office workers. Um, what are your thoughts on that? And I'm wondering if you can address something that, I've been concerned about, and I know that, is on the minds of educators everywhere, that working remotely, and when we see some companies saying you can work remotely forever, that has different implications for the young person who has not yet had the opportunity to create a network, to build trust relationships, to learn the nuance of the organization in which they're working, as compared to those of us who are further along in our careers and have been able to fall back even over the course of the last year on well-established networks of friendships and trust to get things done. What are your thoughts on working remotely and its persistence in a post-pandemic environment?
I mean, I think we've swung the pendulum pretty far, and it's likely to come back, right? So we hired 3 new economists in my department, and they joined us in August. And I'm delighted they're here. I don't know them very well, and it's not good for their development as economists within the department. It's not good for me, right? That we've hired these 3 people, and their expertise I can't really tap as well as I could my other colleagues. So I definitely think that we're in a moment and it's sort of a necessity. But I don't anticipate that in the long run, this will be our work from home pace. Will there be more work from home than there was in February? Yes, absolutely. But I don't think we should expect that the majority of work will shift to people's living rooms. I don't think that's a reasonable expectation.
Overall, would you say that you're optimistic on where we'll be a year or 2 years from now?
I'm optimistic, but I think, that's relative to the exceptionally slow recovery from the 0809 recession, right? So as you know, it took us 6 years to claw back all the jobs we lost in the financial crisis. And so, if we do better than that, if we have that, I'll be happy, because it was just an incredibly difficult and costly time. And so I'm hopeful for a better pace of recovery than before.
Great. Marianne, thank you so much for your time.
Sam, thanks for having me.
Sonia, we are coming out of a historic election. We learned on Saturday of the results, and President-elect Biden and Vice President-elect Harris heading to the White House. The potential for a rocky few weeks between now and then, as we resolve some of the outstanding issues or concerns that have been raised. Overall, though, with that result in mind, what are your expectations for how the broader economy will perform towards the end of 2020 and in 2021 as well?
I'm glad to see us having made it past the election that resolves some uncertainty going forward. I think we still have to resolve some of these issues that we're seeing. Wall Street versus Main Street. I think if you looked at the stock market, you're thinking things are going pretty well overall. That's looking really great overall. However, on Main Street, we still have a few issues. We have unemployment to contend with. And some of that is turning into long-term unemployment at this point. And we have to deal with some of these other rifts that we're experiencing in the economy. There's not a quick comeback on this one. And I think it all comes back to how we handle the virus. If we are able to emerge from this pandemic and we continue to socially distance, wear masks, and have a plan in place on how we want to face this virus and hopefully get effective immunization, then I think we will be stronger for it. And so I have an optimistic outlook, but getting the timing just right is tricky on this one because so much does hinge on that virus.
You mentioned long-term unemployment. We're going to be joined by Marianne Wanamaker, a colleague of both of ours, who served with the Council of Economic Advisors, was the senior labor economist on the council. We didn't have a chance to actually touch on the question of long-term unemployment. Can you elaborate a little bit? What segments of the labor force are most at risk for long-term unemployment, or face the greatest hurdles in re-engaging in the labor force?
Yeah, certainly. Right now we're standing at roughly 7% unemployment, but you still have over half of the jobs that we lost in March and April haven't returned yet. So the sectors we're looking at that are highly impacted are, to no surprise, the restaurant business, entertainment, arts, and so these are some of the areas we're watching very carefully to be able to see when and if those jobs will actually return. And there is some uncertainty there because while even if we do get vaccinations, I don't think we'll see an immediate spring back in how the economy will perform, or even those sectors will be able to perform. And there are some other shifts that have happened along the way that I think we have to pay attention to, particularly when you're looking at unemployment. namely the ability for a lot of folks to be able to work from home at this point or work from anywhere. And Zillow has made these changes, other tech companies have made these changes, and other industries in general have. And so we will see some impacts there when you're thinking about, you know, the local deli down the street in the downtown area that used to have a very high clientele based in downtown buildings that work there. And now you won't have as much of that anymore. So how is that going to play out? It's too soon to tell, really. But there we're going to have some major impacts from some of these other changes.
So to your point about some of the challenges in the labor market, the Federal Reserve has, I think, clearly signaled that its intention is to remain very accommodative in monetary policy until such time as conditions arise that they're not able to be accommodative. A critical piece of the housing picture that you're looking at is what happens with mortgage rates. What's your general sense of what may happen, what direction we may see for interest rates, mortgage rates, and inflationary pressures in the economy over the next year?
Yeah, and I think you're absolutely right that the Fed has been very clear that they're willing to keep that Fed funds rate low. And I think mortgage rates will therefore also stay relatively low, and they bounce back and forth to some degree. But right now we're still looking at mortgage rates for 30-year fixed that are right around 3%, and that is low. And so our expectation is for that to stay low and boost affordability in the housing market for sure. We've been for years waiting for the other shoe to drop on inflationary pressures, and we've been talking about it. Hasn't happened yet. So I think inflation is not, at least my main concern at this point, to kind of look towards the next year.
Sure, and I think it would be fair to say we're all always on guard as economists for the possibility or signals of an increase in inflationary pressures, but
right.
There's certainly been no indication that that would be the most likely outcome for 2021. I want to talk about housing and some of the things you mentioned with regard to working from home or that you also described as sort of working from anywhere, which I think is sort of the more apt description. Before I do that, in terms of your biggest concerns with regard to the economic outlook, is it the possibility of political obstacles to progress and policy making? Is it the potential for a slow deployment in the vaccine once it becomes available? What are the biggest risks that we all need to be attuned to?
Let's get our grab bag together on that one. I think there are a lot of potential risks that we face on this one. You hit on a couple really good ones. The biggest elephant in the room, of course, remains the virus and our response to the virus. How fast will we actually end up getting a vaccine? What will the deployment of the vaccine look like? Will it be accessible to everyone? And of course, will people be willing to actually take it? And we need a certain amount of a certain level or number of people to be able to be willing to take it in order to move forward there. And so some of these factors remain hanging in the balance, and only time will tell. But I am confident that with strong leadership, we'll be able to have a good rollout of a response there. So that's certainly one of the biggest issues to look forward to. And then geopolitical risks are still there. We haven't talked much about it, but Brexit is still a thing, and it's been a thing. So we'll see how that plays out. And our reactions to how we interact with other players in the world is still at large. And of course, then here right at home, dealing with some of the risk factors there as well. Consumer spending is not looking fantastic right now. Unemployment, like we talked about, is something to look out for. Housing will be interesting too, how that plays out. We've talked a little about, how foreclosures possibly looming on the distance, and a lot of those are in forbearance right now. I'm less concerned about that, frankly, because I do think a lot of those homeowners have a decent amount of equity. That equity situation looks a lot different today than it did in 2008. So I'm actually not super worried there. There will be some churn, but not hopefully nothing too bad. I'm much more concerned on the rental side. It's it's the dark side that I don't think we talk about too much, we have a lot of eviction moratoriums that will be expiring, and then we could be faced with a tremendous wave of rental evictions, and that's going to impact a lot of Americans. And I think that's something we need to pay attention to, and how that's going to play out.
Yeah, and I do want to talk to you about that in a moment. Before we shift to housing, whether it be for ownership or rentals, um, comment on the potential for a K-shaped recovery, and maybe even elaborate on what that means. Is that what we're seeing? Is that what we're likely to see?
You know, it depends on what factor you're looking at. You know, I think we've had a very sharp V recovery in some instances, and there is certainly potential for a bit more of a K shape in there as well. But at least on the housing side, we remain pretty certain that it is going to be a V shape, and we have passed that V. I don't think we'll see, prices aren't likely to drop at this point. Sales will continue, so they have that strong V shape in there as well. And so enough pushing us forward there. How some of these other factors play out in the broader economy, I think it's too soon to tell exactly where we're going to land there. And there is some potential for some seesawing, if you will.
So talk to me about housing. There's so much going on here. We've seen a boom in refinancing. Rates have been so much lower than certainly when I was doing my doctorate. Our textbook would have told us was even possible.
That's right.
So a lot of refinancing activity. There's also this other factor where, at least on the margin, there are people that are choosing to relocate from the urban core to relatively more suburban areas. It is not the mass exodus that is sometimes described. We are not emptying out or hollowing out, our major urban cores. But in terms of the overall picture for housing demand, what does it look like?
You know, I think on the demand side, we're seeing incredible demand, and very strong overall. We're seeing, very strong, tailwinds from different generations about to hit us. We have millennials moving through the funnel and starting to buy their first home, and the bulk of that millennial generation still has to hit the median age for a first-time home buyer, 34. So a lot of demand in there. Then Gen Z is in the pipeline to become renters, and then eventually homeowners as well. So again, very strong demand. Low rates have been feeding into, the demand for home buying as well. And so we are seeing some of that. And in addition, we do believe that some of the movements we'll see coming out of the pandemic, preference for more space, perhaps a larger home office, will also spur home buying. And we'll see some of those effects in manifesting in demand as well. So on the demand side, we're looking quite strong. On the supply side, this is a different picture because inventory is incredibly low. We've seen listings go down by almost 40% on a year-over-year basis. But so far, while I'm sure it is hampering sales have come back incredibly strong. We're seeing 5.6 million existing home sales in September. Very, very strong number. New home sales have come back very strong, and they had been lagging for a long time after the Great Recession. So we're seeing those come back very strongly. Days on market is very low. So how long a home actually spends on the market before going pending, we're down to 2 weeks nationally, which is incredibly tight window to be able to shop for a home. And then there are markets where they're only staying on the market for a few days. So I think the market is churning very fast and driven in large part by tight supply and high demand.
One of the things that you and I have spoken about several times over the last couple of years has been some of those constraints on new home building activity,
right.
Which include everything from lumber costs to relative scarcity in the availability of skilled labor in the construction industry. Which, if labor markets were performing in a way that we describe in the textbook, we'd have wages are high enough that we should see more people coming into the skilled construction space.
Right.
One of the things that I've really appreciated over the last several months has been some of the work that you've done and some of your op-eds that have focused on issues related to minority home ownership. And sort of, we have a couple of minutes left. Could you elaborate a little bit on some of the salient points that you've raised that are just so important for us all to be thinking about?
Yeah, definitely. And I think, setting the stage there, I think we saw some really meaningful, positive developments before the pandemic hit us. We saw increases in the Black home ownership rate, Latinx home ownership rate in particular. We saw some really great gains. And unfortunately, the pandemic has set us back. We do know that even though the virus in theory could affect everyone, it has hit certain communities much harder than other communities. And so if you find yourself being a renter, if you find yourself being working in the service industries or in arts and entertainment, again, these are industries that were particularly hard hit by unemployment, you will feel this pandemic a lot more. And unfortunately, Black and Latinx communities have higher representation on that front. Even women have been hit much harder in this pandemic than men have when you're looking at head of households. So there are inequities here, and you and I both know that the housing market has always been rife with inequities for as long as we can remember analyzing it. So unfortunately, the pandemic is not doing anything to equalize any of these forces and is continuing to drive a wedge here. And we have to do our part to be able to make sure that we recognize these issues and make sure we fix them as far as possible.
Yeah, and I want to come back to one closing point because it's so critical. You described some of the communities or segments of the labor market that have been impacted most significantly. And one of the things that I think doesn't get enough attention is that when we look at re-engagement in the labor force over the course of the pandemic, women have been lagging men. Some of this has to do with the childcare burden falling disproportionately on women, and many kids not having made their way back to school. They may be schooling from home. How would you characterize what some of those trends look like? I want to really make sure that that folks have a clear sense of some of the challenges that we face there, because we don't want to take that step back. But please.
No, it's true. And I think, unfortunately, there's a little bit of that vicious cycle going on, because you're absolutely right that women bear a larger burden on the childcare fronts, and with a lot of kids still being home from schools as they're remote learning, oftentimes that falls on the mother to be able to handle and juggle a lot of these. We've seen a lot more unemployment on women than on men at this point. And then if you look at households that have a female heads, a female head of households, you actually end up seeing that they, more so than men, have a higher rent burden and have a higher cost on their mortgage payments as well. But particularly on the rent side, if you start to dig into that distribution, you start to see that they don't only pay a little bit more for rents, oftentimes they pay a significant amount more. So they're heavily rent burdened. And then if they end up losing their job, or they're not able to take on as many hours because they're also responsible for taking care of the kids and don't have a separate outlet for that, they will lose that very precious income and are put in a position that they could become homeless, or they have to move, double up, any of these destabilizing situations, which we know from research can have long-lasting effects on families, wealth building, and frankly, kids' education outcomes in the future. So I do think that's something to be very mindful of.
You have been a great friend and supporter of the Schack Institute and your alma mater, NYU, over the years. Thank you so much again for joining me today.
Thank you so much for having me. It was a pleasure.